You found it. How to use whole life insurance as collateral for a tax-free loan in Canada. So now, what if I told you that there's a way to access capital for your business or for investments or for retirement without selling any of your assets or triggering capital gains or paying huge tax on withdrawals? Now, if you're a successful business owner in Canada and you're incorporated and you're not using your whole life insurance policy as collateral, you could be missing out on one of the most powerful financial strategies that's available here in Canada. So now let's break it down. My name is Laurent Munier from Safe Pacific Financial, and we help Canadian entrepreneurs, professionals, and business owners to protect, grow, and pass on their wealth using smart financial strategies that are often based on participating whole life insurance. So if you want to learn how to keep more of your money, how to pay less tax, and how to build lasting financial security, make sure to like right now, hit the subscribe button, actually add that notification bell. Now let's get into it. So the strategy is how to borrow against your whole life insurance policy in Canada. So when most people think of life insurance, they think of protection for their loved ones after they're gone. But for high-income Canadians and for incorporated business owners, the participating whole life insurance can be so much more than just a death benefit. It is also a powerful financial asset. So whole life insurance policies in Canada come with a unique built-in feature, which is called cash value accumulation. And this cash value can grow steadily every year on a tax-deferred basis, meaning that you don't pay taxes on the growth as long as the money stays inside the policy. So now over time, this creates a stable, conservative, and reliable pool of capital that you can use. And here's where the real strategy kicks in. So you can use this growing cash value as collateral for a loan from either the insurance company that you have the policy with or from a major Canadian bank or other types of financial institutions that lend on insurance policies. And you can do this without having to surrender the policy or without having to sell any other investments. So this type of strategy is known as life insurance leveraging. There's a lot of names for it. You know, when you implement it at scale, if you're talking to a bank, they want to call it an immediate financing arrangement, or you could see IFA. It's a tax-efficient way to unlock liquidity while keeping your wealth intact and while keeping the protection that you need in that life insurance policy and having all of your money working for you with massive tax advantages. So now what are some of these benefits of borrowing against your life insurance policy? Number one is you can access the money without having to sell assets. So you don't have to liquidate your stock portfolio. You don't have to sell any real estate, and you don't have to sell any business shares or other things that you would need to sell to generate cash to do whatever you want to do. It also, you can use the money without triggering capital gains tax. So it keeps your investments intact and it allows you to defer those taxes indefinitely. By borrowing from your insurance policy, you also get really flexible repayment options. So in many cases, there's no fixed repayment schedules. If it's from a life insurance policy, you have tons of flexibility. If it's from a bank, depending on the bank, depending on how you set up the loans, it's often a line of credit where you can pay interest only at very competitive rates, usually somewhere around prime plus 0.5, prime plus 0.25. Sometimes when you have a higher volume loan, it could be prime minus 0.5, prime minus 1. We've got loans kind of for clients all over the place. These types of loans against your insurance policy also don't impact your credit score. The policy secures the loan, but also because of how the bank does the lending, they don't actually report these loans on your credit score. So obviously, if you are applying for credit at other places, we highly recommend that you are open and honest about your credit facilities that are open, and you should absolutely disclose to anybody in the future that you have these loans out. But the bank is not the one that's going to do it. I'm not the one that's going to do it. The insurance company is not the one that's going to do it. So what else is great about borrowing against your insurance policy is that because you're leaving the money inside the policy, it continues to earn dividends. Your policy continues to grow and it earns these annual dividends even when it's being used as collateral, because the policy doesn't know that it's being used. It's just collecting dividends. And you maintain your full death benefit, and actually you maintain your full and growing death benefit. So when it's structured properly, the death benefit will cover the loan and the rest is paid tax-free to your beneficiaries. So this is especially attractive to incorporated professionals. Real estate investors really like this, and business owners. who are sitting on retained earnings and they're looking for more efficient ways to access funds without pulling taxable income from the corporation. So if you're building a long-term wealth strategy and you want to keep your money working in multiple places at once, borrowing against your whole life insurance policy can be one of the smartest and safest moves that you can make in Canada. So how does it work? Here's your step-by-step guide to collateral loans using life insurance in Canada. So if you are a high income earner, or you're a business owner, or you're incorporated, you might be a high income incorporated professional and you're looking for tax efficient ways to grow and access your wealth, the collateral loan strategy using whole life could be a game changer. So this is an advanced financial strategy. So it's definitely not for everyone, but it's commonly used by affluent Canadians to unlock liquidity without selling assets or triggering taxes. And here's the step-by-step. So number one, you need to own the participating life insurance policy. So this is where it all starts. It starts with a participating whole life insurance policy from a top-tier Canadian insurance company. So this would include companies like Canada Life, Manulife, Sun Life, Equitable Life. And these types of policies are designed to provide lifetime coverage. So it's not only for 10 years or 20 years or whatever. These will cover you for your entire life. They will accumulate guaranteed and non-guaranteed cash values over time. They will earn annual dividends based on the performance of the insurance company's participating account. So as you consistently pay these premiums, the policy's cash value steadily increases from these dividends, which creates a conservative long-term asset on your personal or on your corporate balance sheet. And the dividends that these companies have been paying, all of the companies I just mentioned have been paying dividends for 100 years or more, and they've never not paid a dividend. Now, technically, I'm not allowed to promise you that they're going to pay a dividend in the future, but these policies are designed around paying a dividend. They have paid a dividend for more than 100 years. Some of these companies have paid a dividend for longer than Canada has been a country. So, if you're going to bet, will they pay a dividend in the future or will they not pay a dividend in the future? You can decide. I'm just not allowed to say guaranteed you will get a dividend in the future. So the next thing is that your policy will build the cash value that can be used as collateral. So within a couple of years of funding the policy, and even sometimes sooner if you can do accelerated funding strategies, your policy will have accumulated enough cash to be used as collateral for a loan. So major Canadian banks like BMO, RBC, Manulife Bank, CIBC, they will accept your policies. Actually, Scotiabank does this as well, EQ Bank. They'll accept your policy's cash values as secured collateral for lending. So each one of these banks has different ways that they lend. Some will be demand loans, some will be lines of credit. They all have different minimums before you can talk to them. So some of them you can have smaller policies with some of these banks. Other banks need you to be depositing at least $100,000 or $300,000 a year into the policies. But again, that's where you work with us, and we would place you with, or we would introduce you to the right bank and to set this thing up. Now, the third step is that you borrow against the cash value of the policy. So now that you've got the policy set up and you funded it, you can usually borrow somewhere between 85 to 100% of the total cash value that's in the policy. And this, again, will depend on the bank's underwriting. So they're going to underwrite you for the loan. But yeah, it's anywhere from 80 to 100%. So now you want to compare that against other things. Like if you were borrowing against real estate, banks are not lending you 100% loan to value against a real estate asset. They're definitely not lending you 100% loan to value against a stock portfolio. And again, with your stock portfolio, it would depend what it's invested in. If you're invested in equities, you're probably going to get about 50%. If it's invested in secure things like GICs, you might get like 70, 75%. And so now you're going to borrow against the policy, and this could be either tax-free lump sum, secured line of credit, and it's not a withdrawal from the policy, it's a loan, which means that the money's not taxable, and your policy will continue to grow in the future as you receive these dividends. So you're effectively using the life insurance as an asset to back up a line of credit or a demand loan. Now, step 4, you can use the funds for whatever you want. This is the beautiful part of this strategy. It's the flexibility, right? So you can use the borrowed funds for whatever you want. So this could be investing in real estate as something a lot of our clients do, whether that's commercial or residential. You could expand or fund your own corporation. So, are you opening a second office? Are you building another gym or you're buying another machine or whatever you're doing to expand your company? You could pay off other debts using this because generally we can get you these loans cheaper than whatever your other loans are. Not promising that, but often this has happened. You could fund major life events or purchases, and you could also bridge retirement income gaps in a tax-efficient way, right? So because you're using the policy as collateral rather than withdrawing the funds, the long-term compounding remains intact. So your money essentially could be working in two places at once. So you've got the growth once inside the policy, and then when you borrow it and you've invested in something else, ideally you made a good investment and it should be growing over here. So you've got this thing growing twice. The next step is to set up repayment terms of the loan. So this is something that doesn't get talked about a lot online. A lot of people tell you you can just borrow this money and not pay it back. And technically that's mostly true, but depends on your situation, and it's not always what we would suggest people to do. So this is one of the most attractive features, is the flexibility in repayment. So with collateral loans from a bank, you can often set it up to be interest only with no requirement to pay back the principal during your lifetime. So when you pass away, the life insurance pays out and it would repay the outstanding loan balance. The remaining amount would be distributed to your beneficiaries tax-free. And again, it depends if you're doing this personally or corporately. There's ways to do it. But this makes this strategy ideal for long-term estate planning while also providing the living benefit and liquidity that you need during your lifetime. And so we don't personally recommend not paying it back, especially in your early years when you're in a wealth accumulation stage of your life, because as you pay it back, you can use it again. So generally people want to do more than one thing. So you borrow the money, pay it back, borrow the money, pay it back. So you bought one building and then you did it, and then you bought another building and then you did it, or whatever you're doing. In retirement, you can set up what's called an IRP, which is an Insured Retirement Plan. Those ones, you borrow the money, you don't pay it back while you're alive, and eventually when you pass away, the death benefit pays the bank back, and then the remainder goes to your beneficiaries or whoever you choose. So let me give you a real example of leveraging your whole life insurance for growth and for investment. Now, for you guys to better understand how this works, let me tell you about the client, right? So this is an incorporated dentist in Ontario. We're going to call him Dr. Laurent. So I'm an incorporated dentist in Ontario, and I've built a successful practice, and I've been funding this participating whole life policy for several years. And I've got a couple of $100,000 in cash value inside. And so now I can use this to my advantage. So rather than letting the cash value sit, I've decided now to borrow against the policy using a collateral loan from one of the banks that we talked about. So the lender is well versed in working with professionals, and they're very comfortable lending against the cash value of a life insurance policy and using it as security. So I'm going to borrow $100,000 tax-free. And so with the $100,000, I can qualify for this loan. I can get the money from the bank. The loan is tax-free. There's no need for me to sell my stock portfolio. There's no need for me to leverage my house. And I don't need to worry about triggering capital gains tax by selling something, or I don't need to worry about higher income tax by pulling more money out of my corporation. And this doesn't affect my personal credit score, right? So what can I do now with this loan? Dentist Dr. Laurent Munier over here. This is where the strategy shines, right? I can use the proceeds to invest in another opportunity. So I'm going to buy into a second dental clinic as a partner, so I can now expand my footprint. Or I can purchase a rental property that could generate some passive income and long-term equity. Or I could upgrade the equipment in my existing dental practice, or I could renovate the place so I could improve the client experience and I can potentially increase my revenue. And so because these funds were borrowed and they were not withdrawn, the whole life policy remains intact, and it continues to accumulate these dividends, and it continues to grow, all in the tax-sheltered policy structure. So now I can have money working in two places at once, right? This is the power of leverage. So Dr. Laurent over here, I've created a strategy where my insurance policy keeps growing and it's compounding year after year. And then I've invested the borrowed funds into a growth opportunity without disrupting my financial foundation. So the loan is structured to be flexible. There's no mandatory repayments except for I have to pay my monthly interest cost on it. So this, preserves my cash flow. And then when I die, the policy's tax-free death benefit will pay off the loan balance, and the remainder can go to my family with bypassing probate. And because it pays out tax-free, well, it pays out tax-free. So this approach is really popular with incorporated Canadian professionals, like specifically dentists, like doctors, like lawyers, other types of business owners. We've got a lot of consultants who really like this, or software developers that are independent and who want to maximize the capital efficiency, and they want to build intergenerational wealth, and they want to reduce taxes at every stage of life, right? Now, is borrowing against your life insurance policy safe? The quick answer is yes. And here is why the Canadian banks really trust it. So if this is something that you're considering to borrow against your whole life policy in Canada, right? Obviously, you're going to say, is this legit and is this safe? And the answer is totally yes. It is backed by decades of financial history and bank policy. And especially in Canada, the banks are really risk averse. So let's break it down so that you can feel a little bit more confident moving forward. So number one, it's backed by and secured by the cash inside your policy. It's not secured by your credit, although they're going to make sure that you're creditworthy. So unlike other unsecured loans or traditional lines of credit, this type of borrowing is secured by the cash value inside the permanent insurance policy. And so this means you're not using your house or your personal credit as collateral. There'll be some financial underwriting, and you're probably going to have to give the bank your financial statements for them to set this thing up. But you're leveraging a financial asset that you already own. So this is really low risk for both you and for the lender. And for the lender specifically, because it's a life insurance policy that has over 100-year track record of growing with a dividend, and it's managed by a life insurance company that is very conservative, banks like lending against this because it's like hard to mess it up. Another thing that the banks really like is the policy value never goes down. So one of the reasons that the strategy is so reliable is that the nature of how these participating policies work, right? So it accumulates the cash value every year. It earns the dividend every year from the insurance company's participating account, and it's not tied to stock market volatility. So even in economic downturns or recessions, the policy doesn't lose value. So this is one of the most stable financial instruments that you can get in Canada today. It's trusted by all of the big banks. So this strategy is not some fringe financial idea. In fact, some of the largest and most conservative financial institutions in Canada, like BMO, Manulife Bank, Scotiabank, RBC, TD, CIBC, they actively support this strategy and are actually starting to promote it right now. They've been offering collateral loans against whole life policies for decades to high net worth Canadians, to business owners, and to incorporated professionals. And like I said, why? The loan is low risk and it's backed by a guaranteed asset. The borrower typically has strong financials and a history of responsible wealth management. And the insurance policy itself is underwritten by a high-rated, regulated Canadian insurance company. So many of Canada's most successful families have used this method for generations, for tax-efficient borrowing, for investing, and for passing on that generational wealth through their estate plan. And this gives you really a huge amount of peace of mind for your business and for your family. So when you're borrowing against the policy's cash value, you maintain control over the funds and how you use them. You don't interrupt the compounding growth that's inside the policy. And you avoid forced repayment schedules. So most loans don't have to be paid back during your lifetime. Instead, the loan balance can be settled by the tax-free death benefit from the policy. And then your beneficiaries would receive the remaining value without interference from the CRA and without sending half your money to Ottawa. Now, bottom line, this isn't just a safe strategy, it's a smart and well-established one. It's how wealthy Canadians protect their capital, maintain their liquidity, and build legacy without the risks of market-based investments. Now, when should you do this? When should you use a life insurance policy as collateral for a loan? Now, if you're wondering if is this the right move, well, we'll break it down. Number one, I have to say, this strategy is not for everyone. But if you meet the following criteria, it could be one of the smartest financial tools in your wealth building plan. So you're a high-income Canadian professional or business owner. The strategy is ideal for incorporated professionals, for entrepreneurs, and for high net worth individuals. So if your annual income is substantial and you've already maxed out the traditional registered accounts like your RRSP and your TFSA, this can help put your capital to better use. If you have retained earnings sitting inside your company or your holding company, so if your holding company has built up capital that's not being used or it's taxed inefficiently, this strategy allows you to move the capital into a whole life policy and then access it again through the tax-efficient collateral loans. So it's an advanced move, but it can dramatically improve your long-term financial flexibility if you want to access the liquidity without selling other investments. So selling investments to get cash can trigger your capital gains tax. It interrupts your compounding, and it can lead to bad market timing if you have to do it at the wrong time. But borrowing against your policy, you can access those funds without selling shares, without selling a building, without selling anything. So this means no capital gains tax when you need to use the money, no loss of future investment growth, and no disruption to the compounding and to your long-term plan. Now, if you're looking for a tax-efficient way to fund big opportunities, this is where the strategy really shines. So you're looking to expand your business, you want to purchase more properties, you want to make a private investment, you want to cover unexpected expenses, you want to cover and supplement your retirement income. And you can use these tax-free collateral loans that are backed by the policy. These can be a really smart choice rather than liquidating assets or taking on a traditional loan. And why work with us, right? Well, number one, we specialize in this. This isn't something we do sometimes. This is something we do all the time. These advanced life insurance planning strategies for incorporated Canadians, this is what we love to do and we're really good at. We work with a ton of doctors. We work with a ton of dentists. We work with a ton of lawyers. We work with a ton of engineers. We work with a ton of real estate investors and developers and just generally high income entrepreneurs. And then our goal is to help you to protect your wealth, to create this guaranteed long-term growth, and to access the capital without triggering the unnecessary taxes. Some other reasons to work with us is, like I said, we do this all day, every day, and we have the systems and processes set up in order to get you the right policy, to get the policy set up in the right way with the right insurance company, to make sure that your payments happen every year, to make sure that everything is tracked as far as your taxes are concerned, to make sure that your accountant has everything that they need every year. Actually, it's multiple times a year because sometimes it's on your personal taxes and sometimes it's on your corporate taxes and your year ends might be different. To make sure that the loans are set up with the bank, to make sure that the bank has everything they need every year, to make sure that all these things happen. There's a lot of servicing that goes on the back end that we do to make sure that these policies and that these loans work and that they continue to work. These types of strategies are getting a lot of play right now. They're becoming very popular and they're actually getting kind of trendy. And so you have a lot of people trying to jump into the market saying, hey, I can make a little bit of money if I do this, so I'm going to do this. You don't want to work with somebody who doesn't do this all the time. There is a ton of work on the back end in order to make these things happen. That's not work for you to do, that's work for us to do. But if it doesn't get done, these things can be a disaster. We're actually fixing a couple of these for somebody who worked with another advisor and now has come to us over the last couple of months. And these things are a disaster. And we're having to undo a lot of stuff and redo it just to do it properly. We customize these plans based on the individual, based on your income, based on your business structure, based on your personal goals, your estate goals, your long-term financial strategy. We really get to understand this so that you can get the most out of every dollar that you've worked hard to earn, right? You've worked hard in your business to get to a position where you can do something like that. And we respect that. And we want to make sure that we do a good job to make sure that you're happy. Now, can this strategy work for you? I have no idea. We've never met. You're watching a video on the internet. I've never met you. So next steps, go to the website. It's called safepacific.com. On that website, there are a ton of buttons you can click. Some of those buttons, you'll send us a message. Some of those buttons you can book directly into our calendars. And when that happens, we'll set up an initial meeting. It's a discovery meeting where we're going to ask you a ton of questions that we really want to understand your current situation. We want to understand your organizational structure. We want to understand your family situation. We understand your goals, your concerns, and what are you trying to do over the next period of time and with the rest of your life. And then we'll put together a plan that says, because you said this, here is how we can do that. If this strategy is not a good idea for you, we will tell you. We are not in the business of trying to sell to everybody. That is not a good idea for anybody. It's not a good idea for you, and it's not a good idea for us. So if this is not a good strategy for you, we will absolutely tell you. If it is a good strategy for you, we will also tell you, and we will show you options that work for your situation. And generally, like I was saying, people want to minimize taxes. They want to maximize their access to capital. They want to preserve their investments, and they want to leave some sort of generational wealth to usually their kids without giving half the money to Ottawa. Now, if that's you, go to the website, safepacific.com. The link will be below this video. And if you got value and this video helped you in any sort of way to understand how you can use whole life policies as collateral for loans in Canada, then do all those things the algorithm and the robots love to see. So they want you to see, click on the like button, click on the comment button, click on the subscribe button, hit the little notification bell. That helps share these videos to more entrepreneurs, tax smart, conservative, wealth building Canadian business owners like you that are difficult to find because there's not a lot of you around. So do all the things: like, comment, subscribe, notification, and most important, set up a meeting time with us on our website. It's safepacific.com. That's it for me today. I will see you next time.